Welcome to our video on the diversification trap and why you might already be covered. Today we will explore how broad index funds often provide the diversification investors seek, why high-effort alternatives can add complexity without improving outcomes, and what low-maintenance non-equity options actually make sense. We will proceed step by step and connect each idea with practical guidance for your portfolio. Here is our agenda. First, we will introduce the central concept of the diversification trap. Next, we will cover how index funds provide built-in breadth. Then, we will present low-effort non-equity options like bonds and REITs. After that, we will examine the challenges of direct real estate. Subsequently, we will walk through a simple three-step portfolio tune-up. We will also include quick quizzes to test your understanding. Finally, we will finish with key takeaways and practical next steps. To begin, many investors chase diversification by layering on complex investments outside of stocks. However, this pursuit often adds hassle without improving results. Instead, we should clarify what you likely already own within a broad index fund and identify which additional, low-maintenance tools genuinely help. Let us transition into how index funds quietly deliver tremendous diversification. Before continuing, please note that this video is for educational purposes only and does not constitute financial advice. Your situation is unique, and you should conduct your own research or consult a qualified fiduciary financial advisor for guidance tailored to your needs and risk tolerance. With that established, let us move forward to examine built-in diversification in index funds. A broad total market index fund provides exposure to thousands of companies across sectors and, if global, across multiple countries. Consequently, you indirectly hold companies tied to real estate, commodities, and infrastructure through the supply chains and business models embedded in the index. Paradoxically, chasing niche external investments may reduce diversification by concentrating risk in a narrow segment. Furthermore, index funds offer liquidity, low fees, and market-weighted rebalancing, all of which support long-term compounding with minimal maintenance. With that foundation established, let us discuss what to add only if you truly need non-equity exposure. If you genuinely need non-equity exposure, consider bond index funds and REITs index funds before committing to high-hassle alternatives. Bonds provide a traditional counterweight to stock volatility, and bond index funds make it easy to diversify across issuers, durations, and credit qualities. REITs, on the other hand, provide diversified exposure to real estate across sectors such as commercial, residential, and infrastructure, without the managerial burden of direct ownership. Additionally, maintaining liquidity and low costs allows you to rebalance when markets move, which supports disciplined risk management. Next, let us compare REITs to direct property to appreciate the operational differences. REITs provide diversified, professionally managed exposure to real estate with high liquidity and transparent fees and holdings. Conversely, direct property ownership places you in the role of operator. Your exposure becomes concentrated in a small number of properties and local markets, with low liquidity and high transaction costs. In addition, you must handle tenant turnover, repairs, local regulations, and complex taxes and bookkeeping. Therefore, while both provide real estate exposure, the operational demands and risk concentration are markedly different. Moving forward, we will outline a simple process to tune up your allocation. Here is a straightforward three-step process. First, optimize your core by prioritizing a broad, low-cost total market index fund as the foundation of your portfolio. Second, right-size your ballast by adding bond index funds that match your risk tolerance and time horizon. Third, add only what is required by considering a REITs index fund if you want additional real estate exposure. Importantly, avoid high-maintenance ventures unless you are intentionally pursuing an operating business. Now that we have a process, let us visualize the decision flow with a diagram. This mind map begins with diversification decisions at the center. From there, one branch evaluates core index coverage, including sector breadth, geographic exposure, fees, and liquidity. Another branch addresses your risk profile, including time horizon, comfort with volatility, and drawdown needs. A third branch considers additions, such as bonds with attention to duration and quality, and REITs with consideration of sector mix, while explicitly advising avoidance of complexity like direct property or niche speculative bets unless intentionally chosen. The final branch covers implementation details like rebalancing rules, tax placement of assets, and automation. Collectively, the map shows that you should verify your existing coverage first, Align with your risk needs, add only simple and liquid components, and then implement with disciplined rules. Next, let us test your understanding with a quick quiz. Question: which statement best explains why broad market index funds often already provide the diversification investors seek? Option A: they include only technology stocks, which are the most important sector. Option B: they hold thousands of companies across many sectors and geographies, indirectly covering real estate, commodities, and infrastructure exposure. Option C: they guarantee higher returns than all other strategies. Option D: they remove all volatility from a portfolio. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the option explaining that broad market index funds hold thousands of companies across many sectors and geographies, thereby indirectly covering real estate, commodities, and infrastructure exposure. This captures the essence of built-in diversification, and why chasing niche exposures often adds redundancy or concentrates risk needlessly. Now, let us tackle a second quick question about real estate. Question: which statement about direct rental property ownership is most accurate for most investors? Option A: it is a passive, no-effort investment similar to a bond index fund. Option B: it is essentially a side business that requires new skills, time, and ongoing management. Option C: it provides instant liquidity with low transaction costs. Option D: it is guaranteed to outperform REITs over the long term. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is the statement that direct rental property ownership is essentially a side business requiring new skills, time, and ongoing management. This includes handling tenants, repairs, local regulations, taxes, and liquidity constraints. This comparison underscores why REITs can be a more efficient choice for investors who want real estate exposure without operational complexity. Next, we will consolidate the key points. Here are the key takeaways. Broad index funds provide massive built-in diversification. Complexity rarely beats simplicity over time. If you need non-equity exposure, start with bonds and REITs. Remember that direct property is an operating business rather than a passive investment. Finally, prioritize liquidity, low costs, and disciplined rebalancing. This table shows illustrative allocations for 3 common risk profiles. A conservative profile might hold 40% in total market stocks, 55% in bond index funds, and 5% in a REIT index. A balanced profile might hold 60% in stocks, 35% in bonds, and 5% in REITs. A growth profile could be 80% stocks, 15% bonds, and 5% REITs. These are examples, not advice, and the appropriate mix depends on your goals, time horizon, and risk tolerance. Now, let us summarize the entire message with a final visual. This sequence diagram demonstrates a practical system. You contribute regularly to a broad index fund to capture equity growth. You add bond index exposure to control volatility and manage sequence risk. You could include a small REIT tilt to obtain real estate exposure without the operational burden. Periodic rebalancing keeps your portfolio aligned with your risk parameters and goals. With these mechanics in place, let us move to the summary of the entire framework. In summary, broad index funds already provide the breadth most investors seek. If you need non-equity exposure, start with bond and REITs index funds. Treat direct property as a business decision rather than a passive investment. Keep costs low, maintain liquidity, and rebalance methodically. Before adding complexity, ensure that your core foundation is optimized. Finally, let us close with a thank you and a call to action. Thank you for watching. If you found this helpful, please like the video, share it with a friend, and subscribe for more content. We would love to hear about your diversification strategy, so share your thoughts and questions in the comments below. Your feedback helps us create better videos for you in the future.